I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show. And today we're talking about student loans. They are now going to be due October 1st.
Yeah, most of us all have student loans. It's just a part of our day. It's like brushing your teeth. So this is going to be a podcast on how we could potentially help using your mortgage.
And remember, this is for informational purposes only. This is not financial advice. And of course, student loans have been on a hold, their repayments ever since COVID. And although it did relieve, or at least give some relief to people, it has become a situation where now everyone is so afraid about paying back that debt. They become so accustomed to not paying back the student loans that this is a big news item.
Yeah, and
people are really panicking, or at least just really nervous about how they're going to make these payments.
Yeah, the good news is they've had time to think about this. The bad news is that it's, the time is coming very near to when things are going to need to start to change. So what do we got here?
How many federal student loans are out there? What's the totals? We have 43 million borrowers who have basically borrowed from the federal government these student loans. 92% of all loans are federal. And the total of federal student loans is about $1.6 trillion.
And it makes sense that they're mainly federal just because there's some subsidies involved there. So the private loans are going to be more expensive.
Yeah.
So it shouldn't surprise us or anyone that the majority of them are federal loans.
That's right. And there's just so much to be looking at with this, but right now this is where we're at. In June, a lot of you probably remember, you heard the Biden administration talking about canceling $20,000 worth in student loans and then later that month, the Supreme Court struck it down because it was an executive order, and they said, "No, wait a minute, man, that's way exceeding your power. You're not a monarch."
He's like, "What?"
And it's like with all the president's executive orders nowadays, it's crazy that we just hear all these executive orders.
It's probably worth a shot.
Yeah, it's worth a shot. You never know.
Shot, right.
But again, executive orders that would so if they wanted to do something, that would probably have to go through the House, Senate.
Mm-hmm. Okay, so interest starts when?
It starts September 1st. So
a few days ago.
Okay, so it's just like a mortgage where the interest starts, but the payment lags 1 month. So the payment isn't due until October. So students are going to have to make their October 1st payment, which is paying all of the interest for September.
Yep. So there's payments you can make in arrears versus payments that you can make in the fronts.
Yeah.
But I think, is that technical term in the fronts?
Maybe.
But anyway, so it's like rent. You're always paying that beforehand. On type of mortgages and loans, car loans, home loans, those are always paid in arrears at the end of the month. Okay, you've used this money for a full month. Now give us our interest.
Yeah, maybe we call it prepay or interest or something.
Prepay, yeah.
But the average payment is estimated to be really between $200 and $300. So I put it at $250. And at the end of the day, we're talking about people who went to college. They went to high school. They graduated high school, and then they go to college, and everyone in the country is making a massive deal off of $250 an average payment.
Mm-hmm.
This panic.
I think they're focused on like the bigger principal number, which your point is the bigger principal number. That is big, but on a monthly payment basis,
it's not like $250. I mean, gosh, filling up your gas tank. Why aren't we, we're focused so much on student loans. Anyway, what's crazy is there's so many things that are probably a priority over student loans, but it is something that is just top of the headlines right now. People don't know what to do with, and it can get out of hand if the interest rates are high. Mm-hmm. The Biden administration announced this new income-based repayment plan called SAVE. It's replacing, because he couldn't cancel out people's loans. This is a similar program to the income-based.
Yep, also known as IBR. So it was, what is your income, and do you have the ability to repay? If you don't, they can lessen that payment.
Yeah, so 4 million people have enrolled. If you can save or qualify for, you can take a look at the enrollment process. It's income-based. If you're going to be working for the federal government for 10 years, they forgive your loans, and forgive me, but I do not know why we are forgiving federal student loan or federal employees. I mean, maybe if you're a military, you're law enforcement.
Yeah, first-time responders.
But why are we forgiving all the student loans after 10 years for someone who just works for the the IRS? What the heck? It's crazy. Anyway, it's just those are just the facts. Introducing student loan busters. This is something kind of, because we do mortgages, if you're looking to do a refinance and you don't, you just have to figure out some way to get rid of these student loans. Maybe you are a parent, you co-signed, maybe you're the student and you're trying to get your parents off the loan. You want to refinance, you can go, there is a cheap option or a cheaper option, more affordable option. You can do a cash out. Sorry, we avoid the cash out pricing hit because what a lot of people don't know is if you do a cash out refinance, take cash out, it costs more in the interest rate. So in this case, this option does not. If you're paying off a student loan, the important thing is you have to pay off at least one student loan in full. And I'm going to go into that option. This is the one on the left. And there's a couple other things here. No additional debt can be included in the refinance, such as installment debt, revolving, like credit cards.
Yep, and just to make it very clear, it could be, but if it was, it'd have to be priced as a cash out. So in order to be priced as a rate and term refi, it has to only be student loan debt that is repaid.
Yes, that's right. And you can receive up to $2,000 or 2%. Whichever is less. Most of the time, it's going to be $2,000 because 2%. Most loans are over $100,000. On the mortgages. And then one of the borrowers on the mortgage refinance must be on the student loan. So you can't be just doing the loan and paying off your kids' student loan if you're not on it.
Mm-hmm. And that's a big deal. There are a lot of parents that actually took loans out for their kids. Mm-hmm. Those loans are earmarked for a certain child, but they're actually not on that loan. So it'd be really important for them. Yeah, they have to be on that loan.
So we were going to mention two other options here because there's, when it comes to refinancing, there's a lot of other debt that needs to be paid off. We've noticed a lot of consumers out there increasing their credit card debt, personal loan debt. Credit card debt right now, the average credit card interest rate's about 25%. So it's outrageous. If you have balances, you know what I'm talking about. It's going to be about 25%. A cash out refinance on a mortgage, if you have $50,000 to $100,000, is a very, I think, good thing to be looking at.
Mm-hmm.
And then, a home equity loan is an option too, because the advantage of doing a home equity loan is that you can keep your first mortgage alone. Let's just say you have a low interest rate on your first mortgage. A lot of you do. If you're a homeowner, you probably have a 3% interest rate. If you did a loan, a refinance a couple years ago, you can keep that first mortgage and then put a second mortgage behind it. And this would, we're seeing those interest rates, and I'm just going to say between 9 and 10% right now. It could be very different when the time that you look. Maybe
these home equity lines of credit, they are going to be different. They are a second position lien. Anytime there's a second, that second is expensive.
Yes.
So they're like synonymous. Second, picture if there's a third, it'd be even more expensive. Mm-hmm. So your cheapest and best money is always your first lien.
Yeah. That's right. So if you talk to the Mortgage Brothers here, and of course we're licensed in the state of Arizona, we're going to weigh those options between a cash out refinance here or a home equity loan here. But we'll give you good advice on that. I think the home equity loan works when you're talking about high, like maybe 25% interest rates on $50,000 to really $100,000. People out there have massive credit card debt. Starting to really increase.
I would also say too, the perfect candidate for the home equity loan is someone that has a small first. No, big first. Okay, big first. You don't want to touch the big first, and you go and get a second on that. If you do have a small, which is the opposite, if you have a small first, we would probably recommend that you look at the middle option. In order to do that cash out, if you need to pay for additional things beyond student loans.
All right. Well, this is, the information that we wanted to give to you today. If you have any questions, be sure to comment, give us a call. We'll be happy to go over your loan scenario, and we'll be back.
All right. Thank you, folks.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.